Right now in America, the median household has $87,000 saved for retirement. Not 87,000 invested, 87,000 saved in accounts total, and that's the median, meaning half the country has less. Meanwhile, according to Kiplinger's most recent data, Americans say they'll need $1.46 million to retire comfortably in 2026, which is 200,000 more than they thought they'd need last year. The gap between where most people are and where they think they need to go isn't just uncomfortable. It's structural. It's a canyon. But here's the part the retirement industry never mentions, because it removes the panic, and the panic is good for product sales. That gap runs in both directions. Some of you are sitting on the right side of it, quietly, without knowing it. And the reason you don't know is that being on track for a top 5% retirement doesn't look like what wealth is supposed to look like. It doesn't have a theme song. It doesn't have a Rolex. It doesn't even have a nice car, necessarily. It looks like 3 specific behaviors most people find too boring to continue. This video is about those 3 behaviors. And by the end of it, you may realize you're further ahead than you've ever let yourself believe. I've been running my own business for over 10 years. I have accountants and fiscal lawyers around me constantly. I've watched how money actually moves, not how financial media says it moves, but how the actual mechanism works when you get close to it. I have multiple hundreds of thousands of dollars invested, so this is not theory for me. And the pattern I keep seeing, the one that actually predicts retirement outcomes, is almost offensively simple. Not easy, simple. Let me introduce you to the central idea I keep coming back to when I think about this. I call it the speedometer you never check. Here's the image. You're driving on a long road. You've got a destination. You set a steady pace. You don't feel fast. You don't feel slow. You feel fine. Meanwhile, everyone around you is hitting the brakes, flooring the gas, changing lanes, making noise. The noise feels like speed. The activity feels like progress. But you're the one putting miles behind you while they're burning fuel in place. The speedometer on a car doesn't need to be checked for it to be working. Wealth compounds the same way. And a lot of people who are genuinely on track for a top 5% retirement outcome have never stopped to look at the gauge because the ride has felt ordinary. This video is your gauge check. So what is top 5% exactly? According to New Trader U's analysis of Federal Reserve data in 2025, the net worth threshold for the top 5% of American households starts at approximately $1.17 million. Top 10% starts at roughly $970,000. And the median American household net worth, the person sitting exactly in the middle, is $192,000. According to the Federal Reserve's 2022 Survey of Consumer Finances, which remains the most recent comprehensive snapshot available. So the gap between median and top 5% is about $1 million in net worth. And the behaviors that bridge that gap are not exotic. They're consistent, they're boring, and they're the subject of the next 15 minutes. Before I get to sign one, let me introduce you to 2 people. I'm going to call them Marcus and Dave. They work at the same mid-sized company in Ohio. Marcus earns around $85,000 a year. He drives a 10-year-old Toyota Camry with a dent in the back bumper he keeps meaning to fix. He brings lunch to work most days. He and his wife vacation once a year, usually somewhere within a day's drive. Dave leases a new Tesla, talks about his crypto positions over lunch, explains his multiple income streams to anyone who stops moving long enough. He has 2 brokerage apps on his phone, checks them before 9 a.m., and recently put some money into an emerging markets fund because he had a good feeling about it. Dave feels like he's working towards something. Marcus doesn't particularly feel like anything. Keep these 2 in the back of your mind. We'll come back to them. Sign number 1, and I'm starting here because it's the most underrated signal on this entire list. Your savings rate causes mild, persistent discomfort. Here is the current average personal savings rate in the United States, 4% of disposable income. That is the number from the Bureau of Labor Statistics. As of 2025, 4 cents kept for every dollar earned, 96 cents out the door. And I'm going to be honest with you, that number should horrify you, not because you're below it, but because of what it tells you about what's considered normal. 4% is what the system defaults to. 4% is the water most fish swim in. Now compare that to the savings behavior of the people who actually end up wealthy. SoFi's analysis found that the average savings rate for the top 1% of American earners is 38%. Not 4, 38. But here's the thing, and this is where the story gets genuinely interesting. High savings behavior isn't exclusive to high earners. According to Boredom research drawing on Federal Reserve data, the key factor for reaching the top 10% of retirement wealth wasn't crossing a specific income threshold. It was maintaining a high, consistent savings rate, often 15 to 20% or more of income over many years. And Ramsey Solutions research found that roughly 70% of millionaires earned under $100,000 a year while building their wealth. Let me pause on that statistic because the finance industry does not want you to internalize it. 70% of millionaires were not high earners, they were high savers. And those are completely different things. High earners who spend almost everything they make have almost nothing to show for it in retirement. It happens constantly. I've watched it happen around me. A physician pulling in $300,000 a year who retires at 65 with a six-figure debt load and a lifestyle they can't afford to maintain. The income was always there. The gap between income and spending, it was never large enough to do anything meaningful. Here's the math. People avoid running. If you earn $100,000 a year and save 4%, you're putting aside $4,000 annually. If you earn $70,000 and save 20%, you're putting aside $14,000. After 10 years of compounding at a reasonable return, the $70,000 earner has built substantially more retirement wealth than the $100,000 earner who spent 96 cents of every dollar. The number that matters isn't the size of your paycheck. It's the size of the gap between what you earn and what you consume. That gap is your wealth engine. That gap is what eventually becomes the speedometer reading that surprises you. The discomfort you feel at a savings rate above 15% is not evidence that you're doing something wrong. It is evidence that you're doing something rare. A friend of mine who runs a small construction business described his savings habit this way: always a little tight, but never actually broke. That sentence should be printed somewhere. That is what structural wealth building feels like from the inside. Not abundance, not ease. A small, manageable, tolerable pressure that is year after year doing enormous work underneath the surface. In a few minutes, I'm going to show you why the composition of your net worth matters even more than the total, and why a lot of people who feel wealthy are actually trapped in a structure that doesn't fund retirement at all. But first, sign number 2. Sign 2, and I'll say up front, this is the best sign on the list. Your portfolio bores you. This is going to offend some people. Good, that means they're hearing it. There is a certain type of investor who checks their portfolio multiple times a day. They have opinions about individual stocks. They moved into a sector ETF a few months ago because they had a strong thesis. They found a YouTube channel that convinced them to put some capital into a thematic fund. They are, by every behavioral finance metric, actively engaged. And according to the actual data, not opinion, not theory, actual Morningstar data published in February 2026, they are almost certainly underperforming a boring index fund. Here are the numbers. In 2025, only 38% of actively managed mutual funds beat their passive index counterparts after accounting for fees. That's down from 42% the year before. So in a year full of volatility, tariffs, geopolitical risk, the kind of environment where active managers claim to have an edge, only 38% of them actually beat the thing you can buy for 5 basis points. But that's the short-term number. Zoom out and it gets much worse. Morningstar found that just 21% of active strategies survived and outperformed their index counterparts over the 10 years ending in June 2025. 21%. Meaning 79% of professional managers with analyst teams and multi-billion-dollar capital bases and decades of combined experience did not beat what a retired postal worker in Kansas can buy from Vanguard for free. And Spiva's data goes further. 95% of actively managed large-cap core funds have lagged the S&P 500 over the past 10 years. 95%. Let that land. You might be thinking, well, I'm picking stocks myself, not paying a manager. Okay, You are competing against firms with hardware that can execute a trade in 300 microseconds. You are finding information they haven't already priced in the most efficient market in human history, against people whose entire professional existence is devoted to this problem full-time. And you're doing it in your spare time, after work, with a Robinhood account. Good luck. I genuinely mean that, not sarcastically, just literally, you are going to need luck. But here's the fee dimension, because this is where the math becomes almost violent. Average expense ratio for index equity mutual funds, 0.05%. Average expense ratio for actively managed equity mutual funds, 0.64%. That's the Money Guy Show's analysis of industry data. Over 10 times more expensive on average. And compounding makes that difference. Compounding in the wrong direction. Let me give you a story. Two investors, same age, 35. Both start with $100,000 and add $10,000 per year for 30 years. Both portfolios earn 7% gross annually. The only variable is cost. Investor 1 uses low-cost index funds at 0.1% in fees. Investor 2, this is someone like Dave, by the way, uses the default recommendation from a traditional advisor at a 1% advisory fee plus 0.5% in mutual fund expenses. Total cost, 1.5%. After 30 years, Investor 1 has approximately $1.7 million. Investor 2 has approximately $1.2 million. The difference is $500,000. Not from market risk, not from bad timing, from fees. The financial industry quietly harvested roughly 30% of what Investor 2's money could have earned. This comes directly from analysis published by My Online Calculators, and you can run the numbers yourself. $500,000 gone. And Investor 2 probably checked their account more often, had better conversations about it at parties, and had more interesting things to say about the market, and ended up $500,000 poorer for the effort. If your portfolio is boring, 3 index funds, auto contributions, rebalance once a year, sleep like a baby, you are almost certainly paying less in fees, capturing more of the market's actual return, and outperforming most people who are working significantly harder at this than you are. The boredom is not a failure of ambition. The boredom is the alpha. That's the part the finance industry can't package and sell, which is exactly why you never hear it in an advertisement. By the way, hit subscribe if you like the content. Otherwise, YouTube's algorithm may genuinely never put me in your feed again. Now, before sign 3, I want to be straight with you about something. Knowing the numbers is one thing. Building the actual system around them, the withdrawal strategy, the tax sequencing, the bridge to Medicare if you retire early, the Social Security timing math, that's a completely different problem. I had all of this data for years before I actually sat down, ran the real numbers on my own situation, and built a real framework around it. And one of the things that kept coming up in that process was how many invisible costs and structural traps exist between I have the numbers right and I've actually planned the exit. I built a digital book called The Exit Code. It's built on 50 years of actual retirement data, not opinion or general advice, and it's designed to turn maybe someday into a specific date with a specific number. 2 things from it that are directly relevant to what we've been talking about. The 4%. Trap why the original 4% withdrawal rule breaks under specific sequence of returns conditions, and the dynamic withdrawal method I cover in detail as a replacement. And the 58% rule, which is about the buffer strategy for people who might face an involuntary early exit from the workforce. Because the data shows that a majority of early retirements aren't planned, they're triggered by health, company layoffs, or caregiving demands. If you don't have a buffer model, you're flying blind into that possibility. The exit code is less than a dinner out through the link in the description. Every year you don't have this figured out, the math is working against you at compound interest, right? Sign 3. Sign 3. Your net worth is not mostly your house. This is the sign that separates people who will be financially free in retirement from people who will be house rich and cash poor, which is a form of poverty most people don't recognize until it's expensive to fix. Here's a data point that I think deserves a moment of silence. According to analysis of Federal Reserve data published by Wealth Tender, At the median net worth level in America, home equity represents 59 to 73% of total wealth for households in their 50s through 80s. More than half of everything most people have is sitting in their walls, in a structure they live in that they cannot draw income from, that they cannot liquidate without either selling their home, taking a HELOC, or executing a reverse mortgage, all of which have significant costs, complexities, and limitations. Compare that to the composition of wealth at the top of the distribution. For households in the top 1% of net worth, home equity represents less than 15% of their total wealth at most ages, sometimes as low as 4%. Because at the top of the wealth distribution, the asset base is not real estate appreciation. It is investable assets, equities, index funds, taxable brokerage accounts, business equity, things that compound, things that produce cash flow, things that can be drawn from without selling the roof over your head. Let me give you a concrete illustration of why this matters. Two people, both 60 years old. Person A has a house worth $500,000, no mortgage, and $80,000 in a 401k. Net worth, $580,000. Looks respectable on paper. Sounds like someone who did okay. Person B has a house worth $250,000 with a small mortgage, $250,000 in a taxable brokerage account of index funds, and $150,000 in a Roth IRA. Net worth, roughly $600,000. But here's the retirement reality. Person A's income in retirement is Social Security, plus whatever they can squeeze out of $80,000 in a 401k. The house produces nothing. Person B has two accounts they can draw from tax efficiently, a paid-off strategy for healthcare, and a growing income machine. Person B retires better by a significant margin with slightly lower net worth. This distinction matters. Home equity is not income. Home equity is real estate appreciation that you can't spend without disruption. And the financial mainstream celebrates homeownership so universally, so uncritically, that a lot of people have spent decades building enormous home equity while neglecting investable assets. And they arrive at retirement discovering that their balance sheet looks better than it functions. The top 5% in retirement wealth has investable assets that generate or can generate income. The house is where they live, not the retirement plan. Here's the comedic version of this problem, which I'll give you because the tension needs to break. Imagine explaining to a 62-year-old that he has $1 million in net worth. He's thrilled. I'm a millionaire. Great. Can you access any of it without selling your house or paying a 10% penalty? No. Can you live on it for 20 years without touching the house? Also no. Congratulations. You've won a very nice museum exhibit. Yes. That is the situation for a non-trivial number of people who feel wealthy and technically are not retirement functional. The number on the paper is real. The liquidity to survive on it is not. This is where I want to come back to Marcus, because the subplot resolves here. Marcus, remember, the Toyota, the packed lunches, the guy whose coworker Dave had the Tesla. What Marcus did over 15 years was not accidentally profound. He maxed out his 401k 13 out of 15 years. He and his wife opened a taxable brokerage account when the 401k hit contribution limits. Low-cost index funds. They made mortgage payments normally, didn't rush to pay it off, and put every extra dollar into investable assets instead of home equity. Their house appreciated, of course it did. But Marcus ran the numbers, and home equity was about 28% of his total net worth when he handed in his retirement notice at 54. The other 72%, growing, compounding, ready to generate income, liquid. His portfolio was boring. His savings rate was, as his wife described it, kind of aggressive, but we always made it work. He never talked about stocks at lunch. He didn't have a crypto thesis. Dave is still figuring things out. Dave is 49 and has about 90,000 in various accounts and a lot of opinions about the market. Dave's speedometer is noisy. Dave's speedometer is not moving. Now, the fourth dimension of this, and I want to spend time on it because it's the psychological one that most financial content ignores, is that people who are on track for top 5% retirement outcomes frequently report feeling behind. Not moderately behind, significantly behind, like they're missing something. Like everyone else has figured out a trick they don't know yet. And this feeling is almost always a comparison problem, not a financial problem. The modern economy is designed to produce visible signals of consumption and hide the signals of wealth accumulation. The person leasing a $50,000 vehicle has a very visible signal of financial activity. The person with an index fund making a quiet 7% return per year has nothing to show at the dinner table. And because human brains process visible information better than invisible information, the person with the car feels wealthier. The person with the account balance feels normal, sometimes insufficient. But there's a second layer here that I find genuinely interesting from a psychology of money standpoint. The people who consistently build wealth tend to have what I'd call a high tolerance for invisible progress. They're comfortable with delayed feedback. They've internalized, usually through experience or through reading, that the machine runs whether you watch it or not. They don't need the account to confirm their identity. They don't need the number to rise weekly to stay committed to the strategy. That emotional architecture is rare. It's also essentially untrainable from the outside. You either develop it or you don't. People who feel wealthy often aren't building it. They're consuming it. There's a significant difference between financial activity and financial progress. Active trading feels like financial activity. Checking your portfolio feels like engagement. Rebalancing quarterly based on market news feels like sophistication. Almost none of it is actually correlated with better long-term outcomes. Most of it is correlated with worse outcomes. This is deeply annoying to accept, but the data is extremely clear on this point. The speedometer doesn't need you to watch it to keep moving. Let me give you the mini case study with specific numbers, because this is the part where it either clicks or it doesn't. Sarah is 42 years old. She earns $110,000 annually at a corporate marketing role. She's been at it for 12 years. Her savings rate over that period has averaged about 20%. She puts $12,000 a year into her workplace, 401k, including a 6% employer match. The remaining $10,000 goes into a taxable brokerage account with low-cost index funds. Her total expense ratio on her portfolio is approximately 0.08%. She rebalances once a year, usually in January, while watching college football on mute in the background. Her current investable net worth, not counting the house, is approximately $420,000. Her home adds around $200,000 in equity. Total net worth, $620,000. Her home equity is 32% of total net worth. She does not feel rich. She drives a 5-year-old Honda. She did not renovate her kitchen. When friends talk about their European vacations, she's mostly quiet. Here's what the math says about where she's going. At 7% average annual return conservative for a long-term diversified equity portfolio, continuing to add $22,000 per year in total contributions, Sarah will have approximately $1.17 million in investable assets alone in roughly 15 years. She'll be 57. That's before Social Security, before any home equity, before any inheritance. That number $1.17 million in investable assets puts her at the approximate threshold for the top 5% of retirement wealth, according to the new Trader U and Federal Reserve data we've been working from. And here's the part that matters most. She'll get there not because of a hot stock tip, not because she timed the market, not because she found some product nobody else knows about. She'll get there because she was mildly uncomfortable for 15 years, kept a boring portfolio with low fees, and built a net worth that's mostly investable assets rather than walls. She will not feel like she got there. She will feel like she just kept doing what she always did. That is exactly how it's supposed to feel. Now, before I close, there's one more thing I want to address. It's the objection that comes up every time I talk about this. But Tom, I don't make enough to save 15 or 20%. My expenses are real. I have a family. I have student loans. This is easy to say, and I hear that. I genuinely do. The cost of living in 2026 is not the same as it was in the 90s. The personal savings rate is 4% nationally, partly because the structural pressures on middle-income households are real, not imagined. I'm not going to pretend this is all about discipline and anyone can do it if they just try harder. But here's the honest thing I want to say. The structural conditions that make saving hard are the same conditions that make the gap between 4% savers and 15% savers massive in the long run. The financial pressure isn't an argument against saving aggressively. It's the primary reason to, because the only asset that compounds without additional contributions is money already invested. Every dollar you delay putting to work is a dollar that hasn't started its 30-year job yet. And the comparison to the person who can't afford to save is not the useful one. The useful comparison is, what would my life look like at 65 under the current trajectory? And what would it look like if I found a way to shift the savings rate by 5 percentage points? That math is specific. Run it. The number that comes back is usually clarifying in a way that makes the sacrifice feel less abstract. 3 specific takeaways from this video. Not generic, specific to this topic. 1. Calculate your actual all-in savings rate today, not your 401k deferral percentage. All savings, all accounts, divided by gross income. If it's below 15%, you know what the work is. If it's above 15%, you are doing something that a majority of American households have never done consistently in their lives. That number is your most important financial vital sign. Write it down, track it annually. Every point above 15 is a velocity increase on that speedometer. 2, audit your total investment fee load. Pull every account, add up every expense ratio, plus any advisory fee. If your all-in cost exceeds 0.5% annually, you are giving away compounding for services that, according to Morningstar, Spiva, and about 20 years of consistent data, almost certainly do not add enough return to justify the cost. The Institute of Business and Finance's research is precise. Paying 1% instead of 0.1% in fees over 30 years costs you 22.4% of your ending wealth. On a $500,000 portfolio, that is $112,000. You can recover it by moving to low-cost index funds. Today, it takes an afternoon. 3, look at the ratio of investable assets to home equity in your net worth. If home equity represents more than 60% of everything you have, your net worth is not working for your retirement as hard as it looks like it is. You don't need to sell the house. You need to accelerate the building of assets on the other side of the ledger: taxable brokerage accounts, maxed out retirement accounts, Roth conversions if eligible. Grow the investable side faster than the house appreciates. And over time, your composition shifts toward the profile of the top 5%. Not overnight. Over a decade, lazy investing built more fortune than crypto memes. And I'll leave you with this. The people who retire quietly, early, and comfortably almost never have a story you'd want to tell at a party. They didn't find the right stock. They didn't have a great year. They just didn't stop. The speedometer ran. They covered the miles. And one day, they looked up and realized they were somewhere most people never get. Don't announce it. Just